Hello and welcome to Earnings Echo. We put together the most important information about MercadoLibre. We're diving into their Q1 2026 earnings today, and the top line numbers are frankly hyper aggressive.
Right. I mean, revenue exploded to $8.845 billion.
Yeah.
That is a 49% increase year over year, which completely crushed consensus estimates. Gross merchandise volume hit 19 billion.
Crushed consensus on the top line. Yeah, but the market reaction after hours was pretty choppy. I mean, operating income actually dropped 20% down to 611 million. That squeezed the margin to just 6.9%.
Which it looks like a massive red flag.
Exactly. So you have this mature company growing at startup speeds, but bleeding out on profitability. Are costs just spiraling?
Well, it looks like bleeding out, but management's presentation frames this as a totally intentional dial-up in investments.
Yeah.
The EPS miss is largely manufactured by two specific growth engines they're fueling right now.
Okay, let's break down those drivers. Engine one is logistics rate. They slashed the free shipping threshold in Brazil.
Yes. They made it significantly cheaper to get items delivered, and the volume response was immediate. Items sold in Brazil spiked 56% year over year.
A huge jump, but obviously shipping subsidies directly gut the gross margin. What's the second engine pulling operating income down?
Mercado Pago. They are aggressively rolling out credit cards. The credit portfolio grew 104%, reaching 6.6 billion.
Wait, so when we look at the margin compression, how much of that 20% operating income drop is tied directly to bad debt provisions from this new credit?
Two-thirds of the margin drop comes exactly from that, because the credit book is expanding so much faster than overall revenue.
They have to front load the cash reserves to cover future defaults.
Exactly. It directly drags down current operating income.
Right, so they pay for your shipping and then hand you a credit card at checkout. I mean, it's incredibly expensive up front. Did the CFO try to walk back this spending on the earnings call?
Not at all. The sentiment on the call was entirely unapologetic. They're prioritizing long-term dominance over short-term optimization. They explicitly stated this strategy is not changing anytime soon.
Which brings us to the valuation problem. Wall Street hates multi-year payback periods on customer acquisition. If you run a quick reverse DCF on MELI right now, which obviously isn't an exact science, but it gives an indication of what the market prices into the current stock value, it implies investors expect near perfection on growth, but are heavily discounting these immediate margin hits.
Right, they're nervous about the upfront costs. But management countered this by highlighting the macro runway. Latin Americans currently average just 7 online purchases a year compared to 41 in the U.S.
A massive gap. And they justify the customer acquisition costs using cohort data too, right?
Yeah, the mature cohorts from 5 years ago are now highly profitable, and those profits are funding today's aggressive expansion. The older users essentially offset the dilutive costs of the new ones.
So the AI conclusion here, the core echo for your portfolio, is that MELI is playing a decades-long game. They are actively trading 2026 margins to build an insurmountable moat in retail and fintech.
Exactly. If they successfully become the default digital bank and shopping mall for the continent, traditional Latin American banks are going to have a near impossible time winning those customers back.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.